Welcome to another episode of Wealth Talk by Vivekam. Normally, we'd be discussing results, but today, Trump has just imposed a 25% tariff on India, along with an undisclosed penalty, possibly related to purchases of Russian oil or military equipment. The exact penalty is unclear. Globally, the August 1st deadline for new US tariffs has passed. Trump is imposing import-export sanctions on various countries, with rates ranging from 10% to 30%, though some, like the EU, Japan, and South Korea, have settled trade deals. For others, including India, there's clear blockage. Most recent commentary and results and news focuses on these developments. So this week, before we dive deeper, let's ask, what actions should we take regarding exports to America? Which companies and industries are affected? What are the export volumes? And is any specific sector facing additional penalties or pressure? Let's also get a broader perspective from Prasad Garu about the overall commentary, particularly concerning sentiments abroad towards India.
Brazil's president openly criticized U.S. foreign policy, saying, "We don't want another emperor, since the U.S. can't dictate terms globally. Brazil can afford to speak boldly because it has a trade surplus with America. America exports more to Brazil, so the U.S. stands to lose if relations sour." In contrast, India's merchandise exports and imports with the U.S. total around $47 to $50 billion, and the balance favors India. India even offered to buy more oil from the US to balance trade, but Trump still imposed tariffs. Geopolitically, there's concern that India's growth and partnerships, like BRICS, threaten US dominance. The US wants to keep India in check and sometimes stirs up issues in the region, but these are not the main topics for our discussion. The US, especially under Trump, acts mainly in its own economic interest. Despite provocative actions and rhetoric from Trump, India's mature response, remaining calm and not engaging in social media clashes, is commendable. While the opposition stirs controversy, the government has not retaliated, which sometimes angers critics even more. Even if tariffs are imposed, they would not disrupt India's economy. Only around 20% of Indian exports go to the US, and India's export sector is relatively small compared to imports. So, while some sectors will be hit by higher tariffs, the broader economy won't be devastated. This should be seen as a passing storm. A US business delegation is visiting India in the second week of August, signaling ongoing dialogue. India's market performance and the government's calm response deserve praise, and there's no need for major worry.
Absolutely. The government is maintaining a calm, wait-and-watch stance, not backing down under pressure. As you pointed out, US policy keeps changing, but global markets and investors have adapted to this unpredictability. Despite the major tariff announcement yesterday, the market dropped less than 0.5% and even traded positively for much of the session, showing both market and government stability. We're only discussing merchandise, not service exports, since tariffs have impacted goods, not services, so far. Out of India's total merchandise exports, 3.8 million crores, about 6.24 lakh crores go to the US, around 24%. Even if tariffs impact this entire portion, it's not enough to disrupt business models overnight. Looking deeper, certain sectors, with stronger export ties to the US, will feel more pressure. Key impacted sectors include steel, auto ancillaries, oil exploration, and engineering infrastructure. These areas are likely to be hit harder due to their higher US exposure. Pharmaceuticals, a major export, can be discussed in more detail later. But for now, the main risk lies in those merchandise categories with the largest US export volumes, excluding pharma.
Let's start by analyzing the impact of tariffs sector by sector, beginning with aluminum and steel, then moving to auto ancillaries, automobiles, chemicals, textiles, and other niche industries. Remember, the 6 lakh crore export figure refers only to merchandise from listed companies. Unlisted companies also contribute but aren't included here. The total turnover figure is even higher when all exports are counted, making the affected share less than half. Looking at detailed company data for aluminum and steel, for each, I've listed the sales in the financial year 2025, US export share, what percent of turnover comes from these exports, profit and profit margin. This matters because with a 25% US tariff, a company's profit can easily be wiped out if US exports are a big piece of its profits. For example, Tata Steel exports about 40 TAS 42%, worth 92,000 crore, earning 3,000 crore profit. If they lose 25% on US exports, 23,000 crore is at risk, far exceeding their profits. In such cases, companies are likely to cut exports or sell locally rather than incur losses. Similar logic applies to Jindal Steel, National Aluminium, Hindalco, and other names, where the US export hit would erase profits. So, investors should avoid companies where potential tariff losses exceed profits, even if share prices look low. Moving to autos and ancillaries, many companies like Uniparts India, Harsha Engineers, Suprajit Engineering, Wheels India, Tata Motors have over 20% exposure to US exports, but their net margins are less than 10%. A tariff or tax here could turn profits to losses, especially as their products are specialized for US buyers and not easily sold elsewhere. Suprajit Engineering and Wheels India, for example, look risky right now. On the other hand, companies with under 5% US export exposure, like Minda Corporation, are relatively safe and worth considering even in a falling market. Let's focus on key points. Focus on the percentage of US export exposure when analyzing risk. Companies with high exposure and low profit margins are at greatest risk if tariffs persist. Low exposure companies can present better opportunities in volatile times. The above logic applies across aluminum, steel, auto, and auto ancillary sectors. Always double-check underlying data, and if any companies seem left out, let us know for future updates.
Let's turn to two other export-driven industries, chemicals and textiles. In chemicals, NSE-listed companies reported 78,000 crores in sales over the latest 12 months, with about 20,000 crores, roughly 35%, exported to the US, which is a substantial share. Several companies have significant exposure and may face larger risks if tariffs are applied. Textiles have also faced difficulties. India benefited earlier during Bangladesh's troubles, but now, with new tariffs, Indian textile companies with 35% exposure to the US market are also vulnerable. Certain companies need to be especially cautious to avoid these risks. However, it's important not to write off an entire industry due to problems in one sector. Such a broad approach isn't advisable. But when circumstances demand targeted caution, it's wise to adapt your strategy accordingly.
Let's look at chemicals and textiles next. India has nearly 120 listed chemical companies. Much like auto ancillaries, some chemicals are customized for clients, but most can be sold elsewhere, so companies aren't forced to sell at a loss. If both the Indian exporter and American buyer split the 25% tariff burden, the impact is less severe. Still, companies with high US export exposure, over 30-50%, and low margins could see profits wiped out. For example, Privi Specialty Chemicals, Navin Fluorine, RT Industries, Nosil, and Gujarat Fluorochemicals. It is best for investors to avoid such companies now, even if the price seems low. Only companies with minimal US export exposure or strong margins like Deepak Nitrite or Godrej Industries might be safer, but caution is still advised. For textiles, previous export advantages have faded and higher US tariffs are a big risk. Margins are razor thin, so even minor price pressure can erase profits. Bigger buyers like Walmart may push for lower prices, but all Indian textile suppliers will be squeezed. It's safer to avoid this sector for now. Don't rush to buy or panic sell. If you own shares and are concerned, selling is your choice, but there's no blanket advice to sell everything immediately. Overall, we've reviewed iron, steel, aluminum, auto ancillaries, chemicals, and textiles. Our repeated advice is to avoid companies with heavy US exposure and low profit margins, especially if a tariff can wipe out all profits. Investors unwilling to take losses should sell, or at least not buy anything new. Since policy could reverse suddenly, don't make decisions solely out of fear. Wait for clarity, use discretion, and be ready for updates as events unfold.
As Prasad Garu said, knee-jerk reactions mainly come from traders and speculators who face the biggest impact. Fundamental-based investors like us stay calm and analyze the situation carefully. President's statements can change rapidly, so we shouldn't make decisions based on the confusing atmosphere. Instead, we should decide thoughtfully, monitor geopolitics, avoid new buys for now, and restrict investing in vulnerable sectors. There's no need to react impulsively and regret it later. Our team, especially Prasad, spent many hours researching to provide this useful information. In coming days, we'll discuss more export related topics and company results once big declarations come in. Until then, keep watching and see you next week.